Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of October 6th, 2024. And in this week's episode, it's just myself, Sprocket888, and we are going to take a look at an earnings trade that I put on last week in Micron Technologies. And it's an earning trade that didn't go exactly as planned, but I'm going to take you through how I managed the trade after earnings announcement, what went on, what I decided, what was going through my head, and hopefully I have successfully trimmed the sails of the earnings storm. But before we get to that, I want to give a shout out to the Discord, link in the description below. You can hop in there, say hello to myself, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. You also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format, so look us up wherever you get your podcasts, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's episode, earnings and Micron technology. So first off, before I pull up some of the numbers and the traditional Flappy Bird chart, I'm going to recap here that earnings are a one-time binary event that is one of my favorite trades to play. The reason that I love it is volatility usually becomes elevated just before the earnings announcement, and that is prime time to go out and sell that volatility. And what I'm looking for is I'm looking for a contraction in that volatility, and I'm looking for that volatility to be overextended, because when that volatility is overextended, what that basically means is the range that the price can move into is very, very wide. And if the volatility is overextended, it means that range probably is stretched beyond where the stock will actually move. And so what I do heading into earnings is I will sell that volatility for that week's options expiration, because those are when the coupons are no good. Those are the coupons that have the most amount of uncertainty, and that's really what has the most volatility. And the reason that that's important is because after an earnings announcement, 90% of the time that volatility will just contract and shrink down so fast, because that earnings announcement is the binary unknown event. And what comes after that then, once that's out of the way, that volatility just evaporates and disappears. And so what I like to do is sell that volatility while it's all pumped up and really extended. And then after the earnings announcement, when that volatility contracts, I close out the position that I sold, usually for a fraction of what I sold it for. And all of that becomes my profit. Now, what I'm doing when I take on that sale is I am at risk of something moving outside that expected move. I'm taking on the risk that that price could move into my strikes and beyond my strikes into the money. And I will end up either long the shares or short the shares. So that always is a risk whenever you come into earnings, because you really can't know what's going to happen. You can only know with a probabilistic approach. There either is a high probability or a low probability where that price is going to be post earnings announcement. But it's always a coin flip at the end of the day where you just don't know, and you have to see where it shakes out. So Micron heading into earnings was one of those where the volatility was really, really extended. It wasn't really at 100%. I believe the historical volatility or the IV percentile was in the upper 80s, maybe 87, maybe low 90s. I can't remember exactly when. I didn't actually write it down. And so let's hop over to the chart, and let me take you through the move that happened, and I'll talk about some of the pivots that I did after earnings came out. So if we look at the Flappy Bird chart, this upper red box and lower red box is really where I started the trade. And this was before earnings. I put this on basically the day before earnings were announced. So I put that on right there at the start of that bar. It was good till this Friday. These are 4-hour candles. And I've got this chart fast forwarded up to just before the after hours earnings announcement of Micron. And so as we kind of step through this, we start getting the earnings, and here's that first big candle of the earnings, and we get a jump, and we breached my strike. So this was after hours, and this is one of the things you don't like to see. You really want to see this kind of touch your strike, stay below your strike. If you pop up in there, you want to see it kind of correct down, give this huge move, this big green candle. That's the volatility kind of exploding into the price. And really, you want to see that kind of be an overreaction and kind of come back in. And in this case, we were kind of up there in the money, and I was like, ooh, ouch. So this is kind of opening the next day. So before I go any further, I wanted to kind of zoom out here in price, and I wanted to kind of show you what I was looking at heading into this. So this is a longer term view, and I had a couple of interesting levels here on why I was kind of okay. So keep in mind, we were down here around the mid 90s level going into earnings. Now there's this level right here of probably about 106, maybe 100 to 108, somewhere in that range. And that looked like it had historically been support as we were kind of rallying. And then when we broke below it back here in July, that then became a point of resistance where the stock had kind of crept up and tried to punch through and didn't. So this was a natural reaction level. And so that was also happened to be a good distance away. It was about a 20 delta strike away from where the price was when I opened those up. And so in my brain, what I was thinking here is, okay, statistically, that is the right delta that I would want to sell on the top side and the bottom side. But it had this nice benefit of also being really close to kind of this historical level where I expected some kind of reaction. And so I put the trade on right there. That's why that was laid out where it was. Close to the 105 was my strike. And so if we kind of come back in, you can see we really came up to that, 100, 107 level, and we got a reaction, just as I kind of thought we might get a reaction as we kind of approach that. So sure enough, we're going to kind of keep stepping through here, and we're coming up to the week of expiration, the end of the expiration, and we didn't quite get below the box. So right here is where, this put side was worth penny. It was about a penny the day after earnings. It had no value whatsoever. All the volatility was gone. There was no premium in there. But the top side, I was in the money on the call. And so if I were to go into expiration, I would be assigned those shares and I would be short those Micron shares. So I didn't really want to be short those shares. I mean, I would have been okay with it, but there was still time. I thought, let's put a roll out there. Let's roll just 1 week because you can see we hit this level and we kind of got a reaction. We didn't really punch through it. And I thought, perfect. Maybe this means that we're not really quite getting through. Maybe we'll come back down on the price action, gain a little bit of consolidation, and then go at it again, because it was a pretty solid movement that we had on that earnings. There really wasn't much hesitation. It was a full bar green candle just launching us up in there. And the following trading day really didn't contract back that much, but it started to contract a little. And I was going to lose money on this trade at this point. So this is where I had to adjust my sales, if you would. And so one of the other things you can do if the underlying still has pretty decent volatility. Now, the week of my expiration, volatility was gone. So when I'm talking about volatility, it really depends on when the expiration of that option actually is. But Micron was still a very volatile stock. It's tied to AI stuff. It's got a lot of hype. So going out in time, there still was a good bit of volatility. Now, based on the reaction, and I'll show you some more price action analysis that I kind of looked at, I still had a longer term bullish thesis on this. Now, short term, I was really feeling like this really was an overextended move. But longer term, I was feeling a little bit more bullish on this trade. So I did two things. The first thing I did was I rolled the call side, the short call, out just 1 week. I just wanted just a little bit more time to see if this price would kind of pull back in under that 105 strike. And the other thing I did was I pulled up my put. So I closed out my put for a penny, and then I sold a new put with a much longer expiration. I basically went out to the next monthly expiration. So it was about 40 days or something like that. It was a November expiration, and I pulled that up to about 100. So if you remember, there was that range that I was telling you about, that kind of, 100 to 108, somewhere in there. And I thought, you know what, let's go ahead and pull this put up to that level, because my thesis is longer term. We're going to kind of come back down. We're going to launch off of that, and we're going to kind of go upwards and gain from there. But I needed a little bit more time on the call. And so that's what I did. And I'll go ahead and I'll put those 2 trades on here that I added. So just before the expiration, you can see I've added them here onto the chart. This next red box, this is how long the call roll went for. It just went for 1 more week. And then this much bigger red box goes way out to the 3rd week in November for the November expirations. Now, what happened? Let's keep stepping through this. So next week comes, and sure enough, we open up lower. That Monday comes out. It was a pretty big trading day where everything dropped. And we got punched down. This thing got down to about $98. So this is exactly what I was looking for. I was looking for that pullback below that 105. Because I only went out a week, there was very, very, very little time premium. And once we came all the way back down, when I rolled, we were in the money by a few dollars. So that intrinsic value rolled with me. And then once we fell out of the money, basically below 105, the only thing left in the price is the extrinsic value, or the time premium. But there's not much time premium because it was going to expire on Friday. And so I was actually able to close these out, the call side out, for about 55 cents a share. And I'll show you in the next chart, where all of that came in, but those were gone. Okay. So I'm going to take that box away. And now the only trade that I had left was this short put. So here's where I'm looking for. I'm looking for Micron to gain some traction and start gaining off of here, because the thesis was short-term pullback from an overextended move, but the move was in the correct direction. So we're looking for a little consolidation, and then we're going to look for this to play a little bit more forward. So I'm going to go ahead and hit play on this chart to really get the rest of the, won't step through it. But sure enough, there it comes, the next trading day. Probably could have gotten burned a little bit more time premium because it didn't really start rallying, but here it is. We start gaining, and this is where we kind of finished off the week today. We haven't really launched yet off of there, but you can see we've started now coming off that 100 level, about 102, 103 today in trading. I do have quite a bit of more time out there, so I'm gonna go ahead and zoom out here. Quite a bit more time premium to burn off, but we are kind of heading in the right direction. Now, is it going to come through? So if I pull up the trend line that I was, not that trend line, this horizontal one, this is that level that was potentially resistance and support. So not super confident here, because we kind of gave back and this overextended, and then we're going to kind of come up to this level again. So we might not get through it. We might actually deflect and go down, and I could be in the money in the put side and run the risk of getting assigned these shares. However, I'm okay with that because owning the Micron at this level, I'm pretty not. I am okay with. You can see longer term Micron has really been kind of growing. We had a big pullback. This is really kind of the base. We're close to the base. Well, if it were to pull back to this most previous low, this is really the base of where that all-time high was launched off of. And so the other thing that really wasn't broken so much is this trend up. And I can kind of throw a trend line right in there where, yes, we jumped way off this trend line. We kind of pulled back, and now we're riding on the trend line. So I'm really kind of playing out that long-term bullish thesis here as the time premium kind of decays away. And if we go ahead and take a look at what is that actually mean when it comes to the premium and stuff that I collected, we'll go over to my chart that I put together here on the Micron earnings. So this started out as a short strangle on September 25th. I sold that week of expiration an 86 put and a 105 call. And I sold 3 of those for matching up the position sizing that I wanted to put out there. It was $2.40 for each of those strangles. I did 3 of them, so I collected $720. Now, like I mentioned, earnings came out and we breached my call strike. I was in the money on the call side. So in order to close it out, it actually was kind of costing me money, and I lost money on the call side. Now, the put side was 100% profit, but I was losing money on the call side. So to close out those 3 strangles ended up costing me $2.94. So I could have walked away with a loss there of 882. Now you'd offset that with the 720. So call it kind of a scratch. But the way that the price action was setting up, the way that the volatility was still there for a 1-week attempt at the call side and for a longer bullish thesis on the put side, I went ahead and I rolled it to try to get this, keep the dream alive and extend the play. And so when I rolled that on the call side, I pushed that 105 call out just 1 week. So this would be the October 4th expiration, which was just the very next Friday. And I sold 3 of those for $4.35 each. Now, remember, it was in the money. So that really wasn't a lot of time premium. A lot of that was in the money intrinsic value. Very similar to shorting from the price that it was at. And that let me collect another $1,305 in this trade. Now, because I felt good about the put side and I pulled up the put and sold more at the 100 put, I collected, again, 3 more of those, keep my position sizing up there as a quantity of 3, but I sold 3 of those at $3.22 a piece. So I collected another $966. And then, like I showed you on that Flappy Bird chart, as we fell below my 105 call, and of that week of expiration, the premium and everything evaporated. I was able to close that out for just 55 cents. Now, it ended up finishing the week below 105, so I really could have taken it all the way to expiration, but that was a risk I didn't want to take because it could have taken off from there and rocketed upwards, and that call would have been deep in the money again, and I've been right back where we were when we started the whole thing. So as soon as I got the opportunity to take that risk off the table, I closed that out for 55 cents. So there was 3 of those. It cost me $165 to close that out. Great. This is everything I have out there. I still have 3 100 puts on Micron open. They are out of the money, but not by a ton. We'll really see what the price action happens over the next coming weeks. Theta will be burning off of those as we go. But right now, where it stands, if I add up everything that I have collected from all of these moves, collected about $2,109. Now, that is working against about $7,200 of buying power. So divide that out for my return on capital, and I'm basically looking at almost 30% return on capital. Now, that's if those puts expire 100% worthless, but that's not how I trade. That's not how I roll. As soon as those puts decay enough of their value, I'm going to close them out. Probably this trade will end up around the 20% return on capital, which is still really, really good because remember, this trade has only existed for a week. So a 20% return in a week is pretty good. Now, probably it's not going to get there right out of the gate, so I'm probably going to drag it on for another week or so. But think about it. Even if it goes to 3 weeks or 4 weeks, 20% to 29% return in 3 to 4 weeks on a trade is pretty good if you extrapolate that out and you kind of hit these things again and again and again. So that brings us to the end of this week's episode. Really just wanted to highlight, what can happen in earnings. Really anything can happen, and you really have to prepare and be ready to adjust after that. So sometimes it's call cuts on something, bail out. Sometimes you're going to end up taking the assignment because there's not a role available. Sometimes you're going to go straight down the middle and become a full winner, and that's the best one. But really, you got to be ready for anything that kind of comes out of that. And it's all about trimming the sails and understanding what options do you have, what flexibility do you have to pivot on your play, extend the play, maybe close the play out for a profit, whatever is presenting itself. And it really requires kind of patience, not so much patience, but stable mind, because, it can be really painful, or not so much painful, but more mental tiresome to see going into the red on that position where you're just like, oh, I was so close. But just knowing that the statistics and the probability are there and knowing the mechanics of what you're trading and what you're playing for, if you really take before you enter that, and you're really hunting down the things that have that really extended volatility. So relative to itself, the volatility is higher than it has historically been, which is where we were at with this one in the upper 80% of that historical IV. You really, really have that probabilistic approach. And when you combine that with the price action of calling out, hey, here's the level, and your strike is at that level, and you watch the price action after that's there, you really see that kind of reaction. You see that kind of hesitation. And it's kind of reassuring to say, hey, you know what? Maybe this price level is getting the reaction I want. I get my theta burn off of that. And you look to say, well, if I extend this out just a tiny little bit, I can go ahead and let this finish working its way out, close it for a profit, maybe line up a different strategy overall. In this particular case, I was able to extend it and able to roll both sides, roll one up and the other one out, because it already was a very volatile name. Now, that week of earnings, yes, that volatility absolutely evaporated. But because this happens to be in the AI space, and there's a lot of hype around there, and there's a lot of volatility around all of that stuff, there really was the opportunity to collect more premium at a longer time frame. And so it's all about all the things we talk about here, kind of combining them all, and really putting them to work to things that you watch, things you understand, and really turn it into a mechanical operation. So going through this now, I'm not really so much at a point where I'm really much phased by that. Sometimes I wake up and it's perfectly, hey, diddle diddle right down the middle. That's wonderful. Sometimes I'm breaching the strikes and going deep in the money, but there's no panic. Early on, there was a lot of panic. It was uncomfortable. It was new. You let it play out. You get used to it, and then you start to not worry so much. It's very similar to being in certain bad weather conditions or storms, whereas an individual that might not be used to high winds or rains or things like that, that might be very accustomed to somebody in that particular part of the country, they tend to keep more level-headed and not freak out. But as soon as you get into that, uncertainty, unknown, that's really where you can cause panic. Panic usually drives hastily made decisions, which aren't always thought out and can lead to regrets later on. So really, it's all about knowing the mechanics, knowing the movement of things, sticking with it, and sticking to your plan. So whether or not you happen to have any earnings trades coming up, or you're looking for different styles and trades that match your risk tolerance and your trading style, good luck out there. And remember, think outside the block.